Welcome, Andrew, and thanks very much for taking the time to talk to us today. I wonder if we could kick off with you saying a little bit about Lyrical's value-driven investment philosophy and the geographical focus of the fund.
Sure. So Lyrical is what's known as a value style investment manager. And that means we look for companies that are trading at low prices relative to the earnings that we expect them to produce. And within the Alliance Trust structure, we are just focused on the US market.
Could you also say something about this concept of analysability, which is so central to Lyrical's way of doing things?
Yeah, this is something that I figured out as my career went on. And that is, you can buy a company at a cheap price, but it only ends up working as an investment if you actually get the earnings in the future that you expect to get. And so the idea of analysability is that we can put numbers in a spreadsheet, but at the end of the day, should we really believe these forecasts? And in practice, what we find is some companies are relatively easy to analyze and easy to get their future earnings right. And other companies are really difficult, if not impossible. So we look for certain characteristics like stable businesses or flexible businesses. And so when the world changes, they're able to adapt and still generate the earnings we expect them to. Like today, inflation has become a big issue. And so we want to know that for our companies, if their costs rise, are they going to be able to pass that through in pricing and still make the same margins? So those kinds of characteristics make a business more analyzable, and they increase our chances of getting the future earnings right and getting the investment right.
And what does that mean in terms of the sectors and the industries that you're prepared to invest in and the ones that you avoid?
Well, there definitely are some industries and sectors that we find to be highly unanalyzable. So if a business is incredibly volatile, it's very cyclical, that is far less analyzable than if it is steady and stable. So we stay away from the deep cyclicals, things that are like in basic materials, or the airline industry, very cyclical, very hard to get the future earnings right. We also stay away from things that are incredibly complex or require deep expertise. So biotech companies, it's very difficult to figure out what drugs are going to get approved or not. We stay away from them. We stay away from banks because their balance sheets are so difficult to analyze and figure out the real risks of the business. And then a newer area over the last decade has been areas that are undergoing disruption. So traditional retailers who are being disrupted by Amazon, or traditional media companies being disrupted by Netflix. Again, very difficult to get the future earnings right of those kinds of businesses, and so we stay away.
That must leave you with a relatively short list of industries that you are able to invest in. So can you give me an example of what you would be prepared to look at?
Well, the short answer is everything else.
Oh, okay, fair enough.
One of the nice things about investing in the US is we have a huge capital market. We have the 1,000 largest US stocks as our investment universe. And at the very bottom of that universe, we're still talking about companies that have a value of $5 billion and up. So we have a lot of companies to choose from. And while it's easy to name some specific areas that we don't invest in, they actually don't make up that much of the universe. And so we like to say there's a lot of everything else. People forget about the big diversity of companies that exist out there. There's a lot of businesses we take for granted because they're not in the headlines every day. So for example, we own a company, Whirlpool, that makes home appliances. And probably everybody watching this video has home appliances in their household. And we kind of take for granted that as a stock. So much attention is paid to those FANG stocks, the Facebooks, the Amazons, the Googles, or the energy companies when they're in the headlines, that we kind of forget that our life is full of all kinds of things, and they represent hundreds, if not thousands, of stocks out there.
Could you say something about the performance of the portfolio, maybe over the last, over 2021 and also over the first half of this year.
Yeah, well, back in 2021, we were basically in line with the overall U.S. market, or the S&P 500, which is a good proxy for the overall U.S. market. It was a good year for stocks, and so both we and the market were up around 28%. This year has been more volatile. We've been bouncing around a bit, but still, as we film this, we're right about the same as the S&P 500. Unfortunately, so far this year, it's been a down year for stocks. And so while last year was up 28%, this year we've given back about 20%. We have outperformed over time, over the long history of our firm. But it doesn't come in a smooth, steady pattern. We've had several great years and a couple not so great years, and a lot of years where we're about the same as the market. But overall, the good has outweighed the bad, and we have had a history of outperforming.
Looking back over the past few months, how has the rotation away from high growth companies towards businesses that were previously really quite out of favour impacted the performance of the portfolio?
Overall, the decline of these very expensive high growth companies has been good for our value strategy. We're at the opposite end of the spectrum from those kinds of companies. And so we haven't had the same issues in our portfolio that's going on in those stocks. Many of those stocks are not actually in the S&P 500 index, so it may not be as big an advantage as it might seem. But it is a good thing for value style investing to see the other end of the spectrum, the growth stocks, suffer as they have.
And has it thrown up investment opportunities for you? Have you been able to pick up interesting quality companies at much more affordable prices?
A lot of these stocks that are down, they had high growth, but they didn't have much in terms of earnings. And some of them aren't going to survive. So even if a stock is down 90%, if it's not going to survive, that's still not a good buy. Many others were so expensive that even down a lot, they don't look anything close to cheap to us. So the growth bubble bursting has not turned up that many stocks for us from that area of the market. Fortunately, we have a really big universe to choose from, and the rest of the market still continues to serve up great opportunities for us, and we have a very rich and full pipeline of stocks that we can add to the portfolio.
You've mentioned that Lyrical hunts for bargains among quality companies. How have the companies in your portfolio been affected by the big problems that we're currently experiencing as far as inflation and rising interest rates and slowing growth are concerned?
Yeah, as for inflation, at a high level, inflation is good for most companies. Their earnings inflate too. However, in the past, it's been bad for stocks because while earnings inflate, their multiples compress. And so the earnings go up faster, but the multiples come down even faster, and that results in disappointing returns historically. I would say inflation is for earnings, a good or immaterial thing for most of our companies. As we mentioned earlier, we look for flexible, adaptable businesses, and so these things tend to pass through or not be a material issue for them. Historically, inflation has been good for value stocks. As I said, it's good for earnings, but the multiples on the market come down. Value stocks already have low multiples, and so historically they have not suffered that multiple compression that has hurt the returns of the overall market. And so while it's a long time ago, when we look at the last time we've had higher inflation, we've seen that it's been very good for value strategies, not so good for the overall market.
And what about the prospect of interest rate rises? Are companies concerned about that?
Yeah, for most of our companies, interest rates too are generally a pass-through. They're good businesses that generate good cash flows. They're not reliant on debt to run their business. And so higher interest rates is to some degree a bit of a higher expense, but it's not that material to the bottom line. The economy slowing down, well, that's an issue for all stocks in general. And again, the best thing to do if the economy is slowing down and future earnings aren't going to be as high as people expect is to pay as little as possible for those future earnings, which again should favor well our value approach to investing.
So do you see the recent market sell-offs as a cause for concern for investors, or basically as an opportunity for them to, or you, to go shopping?
We see it more of an opportunity. One, once the market is down, it's already reflected in the prices. The time to get out is before it gets down if you're going to try to time the market. But once it's down, it's already in the prices. There's not much you could do about it from there. And also, once it's in the prices, it tends to then provide upside from there. So if you own the right stocks or the right portfolio, these kinds of sell-offs should be short-lived or temporary.
The other big issue in the world at the moment is, of course, Ukraine. I just wondered how far the portfolio is taking account of the impact of the war, and whether you are, for example, buying stocks that stand to profit from it in the long term, such as wheat supplies or defence stocks.
Yeah, so we're running a US-only portfolio for Alliance Trust. And in the US, the impact economically from the situation in Ukraine has been pretty minor. We've had a few stocks with some not significant write-offs related to Ukraine, business operations in Russia or assets in Russia that they've had to write off due to the sanctions. In terms of defense stocks, the way we operate is we go bottom up and look at what's on sale, and we don't chase what might be the latest fad or hot area. And so we're not seeing defense stocks on our value screen, and so that's not really an issue for our portfolio either.
Could I ask you about ESG? I'm wondering how important to stock selection ESG considerations are for you at Lyrical.
Yeah, it is an important consideration. We look at the ESG risk profile of every stock before we invest. And having poor ESG characteristics is a risk to the long-term health of the business and the sustainability of that business. Now, as investors, we don't just look for cheap companies, we also look for good businesses that are analyzable. And that focus on quality and analyzability naturally fits with ESG. When we find good, simple businesses, they rarely have significant ESG issues that we need to worry about. But we do look specifically at that to make sure. We also engage with our companies that we own to promote ESG issues and make sure that they are aware of them and doing things to improve their standing against those ESG criteria.
So in your experience, do you think that companies are still focusing on their ESG policies, even though they are in the face of bigger, more immediate, well, not bigger, but more immediate concerns such as inflation? To what extent is ESG being sidelined by more immediate concerns?
Fortunately, for the companies we own and look at, we have not seen any evidence that the current economic issues are doing anything to change their ESG targets or their adherence to ESG principles. So I think this may be a company by company issue, and maybe companies that are more economically sensitive, that are suffering more in the current environment, might be thinking this. But to be honest, I have not seen this happen at all with the companies that we're looking at.
So at a more granular level, are there particular sectors where you're finding particularly plentiful opportunities at the moment?
Yeah, we're finding plentiful opportunities all over, not from one specific area. And this comes from our bottom-up approach. We don't need large areas to become cheap. We just need individual companies to become cheap. And so in the current environment, what we're seeing a lot of is kind of the best kind of investment you'd hope for. We're seeing companies that have had good earnings, growing earnings, but with the pessimism that's crept in the market, while the earnings are going up, the stock prices come down. And by earnings up and stock down, the companies have become very cheap. A recent example of this is a stock we added a few months ago, Global Payments, which we added back in April. They're one of the largest credit card processors in the world. And if we go back a year before, we see that this was a stock that was over $200 a share, making $8.40. So they had about a 26 multiple on their earnings. Their price was 26 times their earnings. And this is a great company. It deserved a high multiple. Over the last decade, it had grown its earnings at 18% a year, which is about triple what the S&P 500 has done. Now you fast forward a year later to when we bought it a few months ago, and the stock is almost in half. It's down 45%. But while the stock is almost in half, the earnings are up almost 25%. And so the multiple's been cut by more than half. This was a 26 multiple stock, a good company at a rich price, not something we'd be interested in buying. But now, a year later, with the stock almost half and the earnings up almost 25%, it's only at around 11 times earnings. And that is very attractive to us, especially for such a good company with such a strong growth rate.
Yeah, great example. Can you give us an example of a bad call that you've made over recent months? Either something that you failed to act on or a stock that disappointed?
Yeah, well, in a diversified portfolio, which is what we try to do, you never have every stock working at the same time. And one of the reasons to be diversified is unexpected things happen. So one company that's been struggling of late is a company called Qurate. And they're the parent company. They own the QVC and HSN home shopping networks that you may see on television. And their business was great during the pandemic. When everybody was stuck at home, more people were watching QVC and HSN, and they were buying more goods, and their business was booming. And so one issue they have is they're coming off of those exceptionally good times. But another issue that was really impossible to see coming is their largest warehouse and fulfillment center burned down. And while it is covered by insurance, it is creating disruption to the business. We think they can work through these issues, and we think that it's excessively overcounted in their stock price, as this company trades for just over 3 times earnings. So expectations are very low. But that's a situation of a company facing a number of issues that we did not fully foresee, especially the fire in the warehouse.
Are you going to hold on to the stock?
Yes, we have been holding on to the stock. And we will continue to hold on as long as we have conviction in the business.
So finally, could you tell me about a wildcard stock that you hold, which might be something that's not terribly well known, or a little bit unusual, but you think has got potential looking ahead?
Yeah, we have a few. I'm not sure I would use the word wild card, but we have some very deeply discounted companies that offer exceptional upside in our opinion. One of them is CommScope, which is a leading producer and provider of communications equipment. The hardware the physical hardware that runs the communication networks that we use for our iPhones, our telephones, our cable, our infrastructure. The pandemic delayed a lot of build outs of communication networks, but 5G telephony is here, and telecom networks have a lot of catching up to do. The orders have been really strong at CommScope, but they haven't been able to fulfill all of those orders because of things like chip shortages. And so we see a tremendous amount of pent up demand, although in the short run, that's been a negative as they haven't been able to sell as much equipment as they originally expected due to those shortages. This company's trading at less than 4 times earnings. So we see as those chip shortages ease up and they're able to fulfill those strong order books that they've built up, that this company has a tremendous amount of earnings power ahead of it and a very modest multiple that makes it a great investment for us. Now, it does have a lot of leverage on the balance sheet, so that elevates the risk profile quite a bit, which is why I kind of thought to mention it in this category. But this is one that we think could be worth multiples of what it's currently trading at.
How long do you think it'll take to get there?
That's a good question. It looks like the chip shortage is expected to ease up over the course of this year into the middle of next year. It's not a switch that gets flipped, but slowly the chip shortage will ease. And so, the market's forward-looking. So from an earnings point of view, we see the earnings really being much higher after the next year. But the market should be beginning to see that at some point, and the stock usually moves up ahead of when the earnings move up.
Well, thank you so much for joining us today, Andrew. It's been an absolute pleasure talking to you.
Likewise, I appreciate it. Thank you.